Merchandising transactions majorly have two categories of transactions. Yes, so we have purchase transactions and there are sales transactions. This is very logical because many merchandising companies, they are not manufacturers. Before they have anything in the store to sell, they need to buy it, and that's where the purchase transactions come in. And the sales is clearly when they start selling it to their customers. Now, purchase transactions involve two parties: manufacturer, this one, and the merchandiser, being that same, the company from the perspective of which we're making all of these entries. Now they buy from manufacturer, to the merchandiser or retailer. Actually, I'm just going to keep on calling it retailer because it's easier. And the accounts that are involved are merchandising inventory, cash, or account payable, depending on how they buy, on cash or on account. Now, let's go on. The merchandise inventory, technically, in the cost of it, it will include not just the price of an item, but also the shipping charges. So the price would be, obviously, let's say that if you buy a computer from a manufacturer, it's going to be, let's say, $100. Well, computer cannot be that cheap. Let's go with $1,000. And then the shipping charges, let's say, are $100 for that only one computer. And insurance, let's say, is $50. Yeah, and let's say there are taxes of $20. Etc. And if we say that there are other costs that are used to get ready the products for sale, well, let's say it's about $10. Yeah. So eventually, when we will have our merchandise inventory account, it will include not just this price, yeah? It's going to include all of this combined. So it's going to be 1,000 plus 100, 1,070, 1,080, $180. Yeah, so this is what's going to be on our sort of account balance. So it's not just the price for the item. Now, the purchase transactions involve the gross purchase, which is basically is not without any reductions of discounts or any allowances. So this is just the gross price or gross purchase of our merchandise. But then let's say if the manufacturer give us a discount, if we have some kind of my pen won't stop moving, excuse me, then we have any returns and maybe we have some kind of allowances, then we will get the net purchase as a again, don't forget, this is from the retailer's perspective, the retailer. Okay. Next, we have, let's look at the specific examples here of the purchase discount. What we need to remember here is this specific term, yeah, which is very important, and you need to remember how to read this one, yeah. So the 2 is the percentage, this is days, this is the total price, and this is again the days. So after the dash we have days, before that the the price or the interest, sorry, the percentage of the discount. So first, before the comma, the very first expression means that the discount rate is 2% if the payment is made within the 10 days period after the purchase, and the full price will be paid without any discount, obviously, if the payment is made after those 10 days, but within the 30 days after the purchase has been made. Yeah, so you need to remember that and commit it to the memory. Let's look at the specific example of the purchase discount. So this example doesn't include the explanation of the original entries, but I will include them just in case. So let's think with this way, yeah. So retailer purchases again. So in this case, despite the fact that we're a retailer, we're buying, yeah. So in this case, the retailer is the buyer. The buyer, he buys merchandise. It buys merchandise for their store from a manufacturer. On September 1 is the date. The amount, the full amount, is 1,600. The credit terms are these from the invoice date of September 1. So meaning that the 0 day, the date 1 is September 1. Now the retailer makes payment on September 5, meaning that it is within those 10-day discount frame, and obviously they will receive a discount. the following will be related to the discount payment. Yeah, so the payment, if the process of payment, if the discount is considered. But also I would like to look at the first entry when we make the sale. So on September 1, we will enter what? The purchase. Yeah, so we buy merchandising inventory or merchandise. Let's go merch inventory. We bought it, so therefore its inventory is going to be debited 1,600. It's on account, so account receivable, account payable is going to be credited 1,600. If we have to look at it in a T account shape, it's going to be merch inventory. Let's just briefly write it this way, 1,600. Our account payable is going to be on the credit side 1,600. Now let's assume that the payment is made within the discount period. We will record we have to get rid of our liability, yeah, 1,600, so we debit that. But since we got the 2% discount, and that's cash payment of T account, again, cash is going to be paid 1,568, not the full price. But the difference, yeah, so we entered these two, but there is a difference on the credit side for the $32, and that is going to reduce the value of our inventory. So we're going to include that into the credit side of our merchandising inventory here, making the total value of our inventory 1,568. And this is actually very neat. This is very pretty how they sort of put it, because account payable goes down to 0. Yeah, so we basically zeroed out. So this is 0. Yeah. Our merchandising inventory, because we received this 2% discount, goes the value goes down 1,568, and we get rid of, well, we're not getting rid of the cash, but we pay cash 1,568. So perfect. And if we assume that they did not make that payment within this 10-day frame, but they paid it within the 30 days, so after, let's say they paid it on September, so if not even September, let's say they paid it September which one? Let's say they paid it on September 15. Yeah, so this is after 10 days, but within those 30 days. In that case, the full amount will be paid, meaning cash will be paid 1,600, and account payable will be going down to 0 again the same way. So this is very simple and very neat. Moving on, we have, besides discounts, we have returns and allowances, and this is very important to remember as well, because the returns are very much a possibility. So let's say something came down completely broken, damaged, you need to return it as a customer, in this case, as a buyer. And allowances, if again there was some kind of mishap with the merchandise that you purchased, and you can get the partial refund. Yeah. So just to remember, like the purchase discounts usually are provided by the manufacturer, so that the sort of customer, the buyer, would pay as soon as possible, so they kind of get the incentive to pay sooner. The returns and allowances, this is a common practice. The allowance might be issued because the merchandiser doesn't want to lose the customer in the future, so this is his way of keeping the customer. And let's look at the example, a specific example of manufacturer who sells 150 candles for $150 in total. The payment has not been made. The buyer is obviously our retailer. Yeah, retailer is the buyer. And 100 of these candles, yeah, the buyer retailer finds out that 100 of these candles are badly damaged and must be returned. The other 50 candles, they are marketable but not the right style, so they're intending to keep the 50. So this is going back. Yeah, going back. This is going to be kept. Yeah, so returned 100 of defective those candles will get a full refund. For the other 50, they will get the $20 of allowance. Okay, when they bought it first, yeah, so the entry was this, yeah, merchandise inventory received, meaning $150 is an increase in the merchandise inventory account, and account payable increased through the credit side, $150. Now that the return has been made, yeah, account payable has to go down, meaning that I've returned 100 of those candles. Yeah, 100 of those candles go back. So I have now 50 candles, and therefore also my account payable goes down. Now I owe only $50. Don't forget, this is dollars, this is all money. Right, so the merchandise inventory now is 50, so we keep those 50. However, so in the return, yeah, so this is return, the physical count also goes down, yeah, because we physically return those candles. But in the allowance that we receive, the physical count stays the same, except the value of it goes down. Yeah, so what's going to happen, because we are not in our books, we're not counting the amount, we're only going with the price of it, the total value of it, we are going to reduce the value. But in the stock, it's still going to be staying 50 candles. So, but we still have to make those entries. So account payable is going to go down by $20, and our merchandising inventory also is going to go down. So the account is 50 candles. However, the value of it went down, and now it's $30. But I still owe $30 for those improper 50 candles that I've received and I've decided to keep.